This is Bloomberg Intelligence.
We're really getting into now the streaming's arms race.
Dish is looking at that and saying we can really build a nice niche for ourselves.
In-depth research and data on 2,000 companies and 130 industries.
The dollar is the dominant concept in the planet.
I think the acquisition is a natural progression of what Microsoft can do with this technology going forward.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
You're listening to Bloomberg Intelligence. I'm Paul Sweeney. Alex Steele is off this week. Well, over the next hour, we're going to dig into the big business stories impacting Wall Street and the global markets. Each and every week, we provide in-depth research and data on some of the 2,000 companies and 130 industries our analysts cover worldwide. Today, we take a look at container shipping's 80% rate plunge. Plus, will the WWE get a knockout bid from potential buyers? But first, sluggish demand in the corrugated packaging space shows little signs of improving. And as industry leaders pull back on production, they're still facing the effects of growing price and volume pressures. For more on how the paper industry could keep from folding, we're joined by Bloomberg Intelligence Senior Basic Materials Analyst Richard Bourke. Richard, talk to us about the corrugated, the paper business. It's a commodity, but the pricing, you can't find it on an exchange. How do you price boxes and paper and all that kind of stuff?
Okay, the pricing mechanism is actually less transparent than other markets, as you mentioned, like for copper or oil and gas. You have the LME pricing this. The pricing is set by industry benchmark publication that comes out the third Friday of each month.
Really?
And it publishes a price, and the buyers and sellers in this industry have set up contracts based on this price. Now, the prices, a lot of the contracts are set up with lags or average pricing or things like that, but there's less transparency in the market, and that's one of the reasons on Bloomberg we're partnering with colleagues at Green Markets, which is trying to develop more transparency into the pricing market.
Interesting. And that's for paper? That's for corrugated boxes? What's that for?
It's for the basic prices like linerboard, which makes up corrugated packaging.
Okay. Is there volatility around that? Because it's just once a month they kind of price it?
There's over the time the volatility is kind of muted.
Okay.
We tend to go in cycles. For example, in a down cycle like we're in now, usually the down cycle lasts 13 months, and it's usually the last 6 cycles that we look back at, it's usually about 12% drop over those 13 months.
And where are we now?
Now we're into the 4th month,
okay,
and we're at about 5% of the 12% there.
Interesting. Okay, so the boxing business, I think Amazon, I think of all the boxes in front of every one of our houses, that exploded during the pandemic. Talk to us about how the market was 2020, 2021, 2022, and kind of where we are now.
Okay, so basically we are dropping back. They're hoping that we're going to drop back to 2019 levels, which is before the pandemic. So initially when the pandemic happened, first things dropped off a cliff, but then people start working from home, ordering things, and it really spiked. So it spiked through kind of the second half of 2020 through 2021, so much that the producers got behind and couldn't keep up. That caused the retail customers to order more than they needed because they were put on allocation and things like that. As you can see, one of the things we talked about was that retail inventories are high across the system. So if the various producers aren't selling their radios, their TVs, their stereos and stuff, they're not ordering more boxes because they're still sitting on their own inventory.
Where do I get boxes? Where do we make boxes?
The U.S. has been referred to as the Saudi Arabia of wood.
Oh, boy.
or trees. So boxes are mainly where there's timber. The Southeast is a big production site, and also out west, Washington, D.C., those areas.
Washington State and Oregon.
State,
okay.
Right.
All right. So that's the supply demand. I don't know if we're in a recession. Probably most economists say not yet, maybe a little bit later, but demand's fallen back on a global basis. Talk to us about the demand side of that.
Well, the demand, part of the boost in demand that we had was there was a shift during the pandemic from services. You couldn't go to restaurants, you couldn't go out to you couldn't get an airplane. So instead of spending your money on that, you ordered stuff.
Right.
Now, as the economy reopened, people started shifting back to services. So we kind of had like a twofold hit to demand. One, people shifting away from goods.
Yep.
And two, recession fears.
All right. So given that I see demand pulling back, as an industry, can I pull back my supply easily, quickly?
Well, they've done that the last 2 quarters. In fact, we looked at it. They've actually pulled back about 20% of their production.
Interesting.
Into the end of the year.
All right. I'll have to see how that plays out. So many facets to the business. Our thanks to Bloomberg Intelligence Senior Basic Materials Analyst Richard Bourke. All right, we've discussed boxes. Now let's turn to the methods to ship them. Container shipping companies' guidance for a robust 2023 may prove optimistic as a key driver of the sector, freight rates, has dropped by 80% in the past 18 months. For more on how the industry can come back from this plunge, we're joined by Bloomberg Intelligence credit analyst Stephane Kovatchev. So, Stephane, it just seems like not very long ago when you couldn't get a container ship, or if you did get a container, it was so expensive. Just give us a sense of how this market has played out over the last couple of years.
If I could boil it down to a couple of words, it would be supply and demand. I think on one hand, during the pandemic, especially the start of the pandemic, we had a surge in demand for finished goods simply because we were not able to travel, we could not go to restaurants, and a lot of us were buying furniture for our homes and tools for our gardens instead. And these goods are often shipped from abroad, let's say from Asia, which pushed container prices up. This is from early 2020 until the end of 2021. And also we've had on the supply side a very limited number of ships. There are about 6,000 container ships in the world, and it takes 2 to 3 years to build a new one. So it takes time to add capacity to the system. So this resulted in a record profitability for the industry. But now looking forward, over the last 18 months, as you were saying, freight rates have plunged by about 80%. So first they went up 5 or 6-fold, and now they've went back pretty much to pre-pandemic levels. So this kind of illustrates the very volatile nature of the container shipping industry. But yeah, looking forward, times may be more difficult for the industry.
So do we also, as a container shipping industry, does it have the risk now of more ships starting to come online just at a time when the demand's not there?
Yes, exactly. That's a potential risk, and companies can always delay the deliveries, or they can choose to scrap more ships, maybe take out capacity by taking out the older ships. But at the end of the day, it's a very competitive industry, and you need to have, those big ships, the new ships that are more cost efficient online on the big important routes in order to be competitive and to get those ships filled. So players do want bigger ships, they want newer ships, more cost-efficient ships. So we have currently about 27 to 30% of the current fleet is on order book, so a massive potential increase over the next 2-3 years in terms of new ships coming online. And yes, as you were saying, demand side of the equation, we all know about the risks there in terms of lower disposable income, recession probabilities, that actually one can see on the terminal about 50 to 60% recession probability for the U.S. and Europe actually over the next 12 months. So yeah, potentially difficult times ahead.
What are the costs for the shipping industry, in terms of going green, making their ships, more environmentally friendly? Talk to us about kind of the regulations or just what they have to undergo these days.
Well, shipping represents about 3% of worldwide CO2 emissions, but it also transports up to 90% of the goods worldwide in terms of volume. So it's definitely a very important industry. It's not going anywhere. I think the key issue that the industry is facing is that the technology is not there yet. Let's say if you want to electrify something small, so something like a scooter or a bike, that's easy. When it comes to electrifying, let's say a truck, you need to think about hydrogen because the batteries are too heavy. And when it comes to a ship that can be as big as a skyscraper, as the Empire State Building, that kind of size, it's even more complex. So we do have some technologies in place. LNG is one, but it only reduces CO2 emissions by about 20%, but it reduces fine particle emissions by 90%. But it's not a perfect solution. So LNG could be one. Bioproducts could be another. We even have nuclear energy as a potential for this to reduce CO2 emissions. But I think to answer your question, the IMO, which stands for the International Maritime Organization, has targets to reduce CO2 emissions by 50% by 2050. So there is still some time, but yes, the industry is slowly shifting to cleaner fuels.
All right, Stephane, thank you so much for joining us. Really appreciate getting an update on the global shipping business. Our thanks to Bloomberg Intelligence credit analyst Stephane Kovatchev. Coming up on the program, we'll see if the WWE has what it takes to entice potential buyers into a bidding brawl. You're listening to Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies in 130 industries. You can access Bloomberg Intelligence via BI Go on the terminal. I'm Paul Sweeney, and this is Bloomberg.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
WWE's $9 billion asking price is at least 2 times the median for general entertainment peers. However, the bigger issue lies with preoccupied potential buyers. For more on WWE's chances at a knockout bid, we're joined by Bloomberg Intelligence senior media analyst Geetha Ranganathan. So, WWE, it's a publicly traded company, Geetha, Worldwide Entertainment, the wrestling guys. They're putting themselves kind of up for sale, but $9 billion seems like a huge number. What's going on?
Yeah, so right now, actually, if you look at their enterprise value, Paul, they are at $6.5 billion. So obviously they are asking a pretty sizable premium. It's a 35% premium to where they're currently trading. But remember, earlier this year, actually, the Vince McMahon, who is the founder, came back to the company, and basically what he said is he wants to, explore all possible strategic options. And so this is kind of, they're looking at what they can get.
You did the valuation work in your research report, and you noted it's 22 times multiple of EBITDA. And again, a big premium to where a lot of these entertainment names typically trade. But on the other hand, live sports, and let's call wrestling a sport, live entertainment, whatever you want to call it, that's still really valuable in the media landscape, isn't it?
Oh, absolutely. I mean, if there's one area that media investors are still pretty bullish on, I would say it's sports rights. We've seen, all of these leagues recently get about 50 to 70% increases in general on their renewals. So valuation typically for whether it's a sports team, whether it's, the leagues, the rights, it tends to be pretty high. And for WWE, I mean, the timing really makes sense because they have some major TV renewals, especially for 2 of their pieces of programming, Raw, which is on NBC, and SmackDown, which is on Fox, which is actually the deals are coming up for renewal in 2024. So they're kind of timing it to coincide with those renewal talks as well. That
kind of brings up maybe potential buyers. Does that put Comcast, who owns NBC, and Fox, I guess that's Warner Brothers, Discovery, I'm not sure who owns what. But anyway, does that make those natural potential buyers? Absolutely. So Comcast, I think, has always kind of been this clear favorite to acquire WWE. So currently, if you just look at core content rights or media rights really make up the lion's share of WWE's revenue. And Comcast is already paying about $470 million a year to WWE. And in a rights renewal, we think that number could potentially go up to about $650, even maybe up to $700 million. So you just do the math and, you kind of look at that for over like 3, 4, 5 years. They're going to end up paying close to about $3-4 billion. So does it even make sense for them to rent sports rights when they could actually just go out and own the asset? So that's kind of been the rationale for Comcast acquiring the company. If you look at Fox, on the other hand, they have an existing partnership for SmackDown. Again, we think it's a really logical fit because if you look at WWE's audience, there is such a huge overlap with the core Fox News, Fox Sports audience. And so it does seem like a logical fit, but I think Fox wants to go down a different path. So they just announced an accelerated buyback program, and we think they really want to go much more aggressively in the sports betting arena. Okay. So probably not going to go after WWE. It's interesting. These media rights deals, I mean, they really are the backbone. But one of the questions is streaming. It seems like your business, Geetha, the TV business, the movie business, it's pivoting towards, away from the traditional cable model of distribution, more towards streaming. Where does WWE fit into the streaming landscape?
So WWE, actually, they were one of the pioneers, I would say, in the streaming field. So they did come out with something called the WWE Network. They got about 1.5, 2 million subscribers, but kind of hit a wall after that point. And then they sold all of the rights to the WWE Network programming to Comcast's Peacock. So all of that is actually currently being streamed on Peacock. So they already do have like a pretty viable streaming solution. And there is a huge audience because Peacock tells us that this is one of their most watched pieces of programming.
Really?
Yes.
All right, if I'm Vince McMahon here, I mean, he's 77 years of age. Does he kind of control the stock here? Is it really his decision to make?
I absolutely think so. I mean, he is the controlling shareholder. He is the founder. He's the former CEO, and he is really the creative force behind the company. So I think he wants, I mean, even if he ends up selling the company, I think he will want to be involved even after the sale.
I'm kind of surprised there hasn't been, I mean, WWE kind of, I'm not a wrestling fan, full disclosure. And now you very well might be, Geetha, but I'm not. But they really dominate the wrestling business. Who do they really compete against for eyeballs and for ad dollars?
I mean, you're absolutely right. I think they pretty much kind of stand on their own. The only other name that comes to mind is, MMA with the UFC, and Endeavor owns UFC. And so, one of the things that investors have kind of speculated is, does Endeavor, which owns UFC right now, does it make sense for them to kind of go out and acquire WWE? And again, I think really the problem there will be the deal size, because if you look at Endeavor, they have a market cap of about $10 billion or so. But they also have huge debt of almost $6 billion. So I'm not sure they can necessarily afford the deal unless they have an additional investor or partner.
Is this a company where a private equity player might be interested in it?
Absolutely, it's definitely possible. We've also heard some rumblings of, the Saudi Public Investment Fund having some interest. Again, nobody really knows right now, so we'll have to wait and watch.
All right, let's pull back a little bit. Just give us the latest on just kind of the big media landscape in general from a stock perspective. They were terrible, as I recall, last year. How are they trading? What's the call on media?
So not so terrible anymore. And the reason I say that is because there seems to now be some viable path to profitability. And we've kind of seen this turnaround in the whole media landscape starting this year. Most of the companies have kind of had a pretty sizable run-up. And what they're all doing is they've clearly articulated a path to profitability, no longer chasing streaming subscribers just for the sake of, a land grab situation. There is a clear path to kind of either get to break even or, sustainable long-term earnings over the near term. And I think that is kind of giving some reassurance to investors.
Geetha, I saw a piece of video just recently. I think it was at some award ceremony, and it was the director Steven Spielberg going up to Tom Cruise and basically saying in his ear, "Thank you. You saved Hollywood," you being Top Gun, and it showed that people will, in fact, go back to the theater. What's your view of kind of the theatrical business? Will people still go back to movies?
Yes, we have seen that in a big way. I mean, obviously, we saw that with the stupendous success of Top Gun, also with, Avatar 2, and even, the most recent release, Ant-Man. All of these movies are really performing quite well. And I would say it's not just Tom Cruise, but I think also the return of Bob Iger, who is such a big believer in the theatrical release. I think that also bodes extremely well for the movie industry.
Because, I mean, you've got the data in front of you, but I remember Disney they've bought so many great studios, from Marvel to Pixar and so on and so forth, and the 21st Century Fox. They dominate theatrical, don't they?
They absolutely do. They make up 50% of global box office receipts. So, Disney's strategy kind of pretty much sets the tone for everybody else. So
do the theater operators, are they going to survive? Have they survived? And what's the future for them, do you think?
Yeah, it's a little bit of a touch and go, and that's mainly because of very, very heavy levels of debt at some of these operators, including AMC. I think, they might be able to survive. Obviously we have some better operators who will definitely do well. To the question of whether box office will ever return to pre-pandemic levels, I don't think so, although I think we might get to about 80-85%. But I think, yes, exhibitors will find a way to survive, even though the pie itself might be a little bit smaller.
All right. Thank you very much, Geetha. We love getting the overview of the media space, taking a little bit of time on WWE. That is up for sales. Our thanks to Bloomberg Intelligence senior media analyst, Geetha Ranganathan. Coming up on the program, we'll take a look at equity hedge funds and whether or not they're ready to take off. You're listening to Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies and 130 industries. You can access Bloomberg Intelligence via BI Go on the terminal. I'm Paul Sweeney, and this is Bloomberg.
You're listening to Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
All right, we're going to be here each and every week at this time, tapping into our Bloomberg Intelligence analysts, covering some 2,000 companies and 130 industries worldwide. Equity hedge funds have been in the doghouse with institutions and investment advisors for not producing enough diversification and charging high fees. But is the sector poised to take off? To answer that question, we're pleased to welcome Bloomberg Intelligence senior private equity and hedge fund analyst Gaurav Patankar. So, Gaurav, my personal experience: left Wall Street in 2005, looked really, really hard at the long-short equity business, parlay my experience in media to the hedge fund business. My conclusion in 2006 was the long-short equity business was a thing of the past. It was dead. I kind of feel like I've been vindicated. I don't know. Talk to me about the long-short hedge fund business.
Paul, that's a great question. And in many ways, you are vindicated, because if you just look at the numbers backward looking over the last 10 years, or even 15 years from the time period, or 17 years from the time period that you're talking about, yes, you're vindicated. Having said that, a few things have changed. One of the biggest things that long-short hedge funds really care about or depend on for the alpha production, it's a combination of a few things. Let's talk about the short rebate. Just the fact that rates have gone up a little bit, the short book really is able to create a tailwind for long-short hedge funds that didn't exist when all we were seeing was rates being cut. That's number one. Second, the dispersion between different companies, different geographies, just the different macroeconomic trajectories that the different sectors, subsectors within those sectors, as well as different countries are taking, is helping with dispersion and the ability to long and short certain assets. Now, granted, this only works if they have the skill to do it.
Yeah.
So I think it's a great environment for long short like it has never been in the last few years.
When I was looking at the hedge fund business, again, kind of back in the mid-2000s, it was quite common for a trader at Goldman Sachs or Morgan Stanley to have 2 or 3 or 4 good years on whatever desk he or she was on, parlay that to go out and raise $1 billion and do your same strategy. You keep all the money. Does that happen anymore?
That's changed a little bit, right? I mean, over the last few years, a lot of the sell-side shops, a lot of the bulge bracket firms have not really had prop desks, or proprietary trading desks, as we would call them. So there's no talent coming in from the sell side.
Okay. Yep.
Having said that, some of the multi-strategy hedge funds have become quite large, and you are seeing some great investment talent that wants to spin out and fork it out on their own. So there are whole entrepreneurial zeal, despite last year kind of having few launches. Few were just under 1,000. So there's still about 900 new hedge funds that came into the market, and a lot of them are equity long short.
What are the strategies that maybe worked in the last couple of years? Like, what's getting maybe some of the fund flows? Where's some of the performance at these days?
Clearly, if you look at the waiting list to just get into some of the hedge funds, multi-strategy platforms have really attracted a lot of attention. Okay. And this is something I'm talking about going back 3, 5, 10 years. They've really delivered consistent returns. Over the last couple of years, one of the other disliked sector, if you may, the macro hedge funds, have really come into their own and have started delivering alpha. And so there is a lot of attention to that sector. Equity long short has just kind of been in the doghouse for the last close to 15, 16, 17 years. And people really debate, am I paying a lot of fees to just kind of get beta, or what am I doing? I think that could change on the margin a little bit, and there are going to be some interesting opportunities there.
So the structure of the hedge fund business continues to evolve in a way that I'm not sure is very healthy for the industry, and that is the big are getting bigger. You know, the Stevie Cohens of the world, the Ken Griffins of the world, they're getting bigger, and it's more difficult for some new players to come in, some new blood to come in. Is that a concern of yours, or is that a concern of investors in the industry?
Look, having worked at one of the largest hedge funds in the world earlier in my career, I see the merits of the power of the platform, or, just given the fact that data is becoming so important, technology is becoming so important, there is some value to platforms. But having said that, now as I work with some of the largest asset owners, CIOs in the world, one of the challenges that I hear from them is it's becoming difficult for them, even at the size of allocations, between $300 to $1 billion per ticket allocation. They're finding it extremely difficult to negotiate with these platforms, even some simple investment management agreements or fee structures, or kind of meritocratizing, if that's a phrase, the fee structure. So I think there are challenges with too few platforms gaining too much power, and it's on both sides. The sell side finds it very difficult to work with just a few platforms. The asset owners, so the buy side of these hedge funds, find it very difficult to get better deals. And I think that's where emerging managers is going to be is an area of interest. It's hard to find emerging managers, but there's clearly a focus on finding more of them as we go along.
I'm always fascinated to see the university endowments at the end of the year when they report kind of their performance. And boy, the allocation they have to private equity, hedge funds, let's just call it alternative investments, it is almost like, to me, it's a little bit worrisomely high. The endowments love the hedge fund business, don't they?
That is partly true, but Paula, what I would say is the endowments broadly love alternatives. So they about 50-60% of an average endowments portfolio is on alternatives, if not higher. And we have been talking about this issue a little bit. I think endowments have gone a little bit too far down the road in terms of being in less liquid private market exposures, and that's causing a lot of challenges for some of them, especially around meeting operating budgets and other cash flow related issues. And I think there might be some lessons learned there. There have been some, like Harvard, that have gotten a little ahead of the curve and have started focusing on hedge funds a little bit early. I think there's more opportunity for endowments to be more focused on emerging hedge fund managers, because that way they can reduce the duration of their alternatives portfolio while still partaking in the alpha opportunity that comes with alternative asset investment.
And are we still seeing funds flowing into the alternative space at a similar rate? Because it just seems that's been one of the just tremendous growth stories in all of financial services, alternative investing, whether it is private equity or whether it is hedge fund. Is that still seeing that momentum?
That's a very pertinent question. I don't know about momentum, but there's definitely positive fund flow in the alternative space as a whole. Of course, there's more positive fund flow and perhaps a little bit of momentum when it comes to hedge funds or less liquid or more liquid strategies or low duration strategies. I think on the private equity side, there is a bit of a challenge when it comes to fund flows into private equity. On the hedge fund side, I think it's a little sunnier.
All right, fascinating stuff. I could talk of this alternative investments all day long. Our thanks to Bloomberg Intelligence senior private equity and hedge fund analyst Gaurav Patankar. All right, let's turn now to European defense spending, where Ukraine's defense against Russia's invasion has illustrated the capabilities and the limitations of the latest battlefield technology. For more, let's welcome Bloomberg Intelligence senior aerospace and defense analyst George Ferguson. So, George, when we see the TV video of the battleground in Ukraine, it kind of reminds me of some of the footage you saw from World War II, tanks, artillery pieces. What are we learning in the first year of the war here from a defense perspective?
Yeah, I think that's a big takeaway from the war so far. There's a lot of excitement in the defense world always about the latest technology and asymmetrical warfare. And for those that don't know what asymmetrical warfare is, it's sort of responding against heavy force with lighter weapons. With smaller bands of troops. It's leaving the old doctrine of sort of massing troops and engaging the enemy that way with big firepower. But what we're finding is that, look, the newer technology, it works. It seems to work best when combined with the older technology, like tanks and artillery and aircraft. And for sure, the older technology not going away, right? So we see the Ukrainians, we're a year on, they're asking for better armor, they're asking for aircraft, they're asking for more artillery. And so, really, land warfare just hasn't changed that dramatically in the 75-ish, 80-ish years since World War II.
Like when I see a piece of artillery, like a big howitzer or something, is that guided in any way, or is that still a dumb bomb? How has that changed since, World War II?
Yeah, so, a lot of the stuff is getting better over the years. And so some of the older artillery, look, we're still guiding it with with the direction you point the cannon muzzle at and the amount of charge you put in it kind of thing. But I think our ability to know what charge to put in and to spot the enemy downrange is getting a lot better, so that's becoming more accurate. But the follow-on to that kind of technology is the rockets. We have MLRS, multiple launch rocket systems. These are sort of the artillery of the future with smart warheads. We can really pinpoint into targets downrange, go further than traditional artillery, and again, do a better job of just pinpointing. So a good example, I think, of some of the technology that's come to land warfare.
So, George, how about drones? What role do they play in the battle?
What we've seen with drones is drones are great for, reconnaissance, getting downrange, seeing what the enemy has, seeing where they're massing. They're also good for small attacks. I think for targets that aren't moving quickly, definitely, for static targets. And they can be used in concert with some of the traditional weapons. And one of the things we point out in our report is the attack on the Moskva, where the Ukrainians used drones, I think, to keep the crew of the Moskva somewhat focused on the drones, while they used an old technology shore-to-ship missile to sink the Moskva. So drones, I think, can facilitate some of the older munitions. In fact, those older, low-speed, shore-to-ship missiles probably should be obsolete. But I think the drones will help them perhaps survive longer. The challenge becomes, too, though, when you get into a very quickly moving battlefield, right? If we get into a spring offensive here where you could have the Ukrainians trying to push forward and take back more of their territory, drones, they're just not as fast as fighter jets. They're not as nimble. You don't have a person up there that's watching the scene on the ground. So when it comes to close air support that you'd use to cover tanks trying to take back ground, they just don't, they don't have the ability yet. And so, they're great. They're cheap. They do a great job of reconnaissance, but there's other missions that they're just not going to do well at. You still need the old technology to do it.
George, you mentioned aircraft a couple of times here. That seems to be the next domino to fall, or maybe not to fall, in terms of the West providing support. Do you envision a time when the U.S. and Western allies do provide combat aircraft to Ukraine?
Yeah, I think that question is going to become front and center here pretty shortly, right? So I think if we're going to supply the Ukrainians with tanks, you're going to find, like I said, that tanks moving without support of good aircraft, close air support aircraft, can be very vulnerable, to both infantry on the ground, anti-tank weapons on the ground, and aircraft in the sky, especially. The Russian Air Force has really stayed out of the engagement so far, and they've left a lot of the activity in Ukrainian airspace to missiles and drones and things like that. But I think if you see Ukrainians with Western armor start to move forward and take back ground, I think you'll absolutely see the Russian Air Force back in the engagement, and you'll need air support for them to make that work. And it just won't work without it. And so I think that question is going to be, it's already brewing, and it's going to become, I think, more intense as the Ukrainians get Western battle tanks and they start thinking about taking back some of the borders.
George, who makes the bullets? Who makes the big artillery shells? We're 12 months into this war, and when we hear the Ukrainians asking for more supplies, I just think about the basic stuff, bullets and artillery shells. Where does that come from?
Yeah, so a lot of the traditional defense primes do that work, right? 155 millimeter howitzer rounds. They come out of General Dynamics, who also makes the M1 Abrams tank. You'll see, some of the missiles. Lots of missiles come out of Raytheon. The F-16 comes out of it. Potentially could be a fighter jet the Ukrainians could use. That comes out of Lockheed Martin. So all of the big U.S. defense primes, we don't hear a lot about the smaller munitions businesses inside their portfolio because they just don't turn the needle financially. A lot of them, though, are in those businesses making those products, all the big defense primes.
All right. Certainly the defense contractors and the defense providers certainly working full-time to, fund this war and arm the Ukrainians here. Our thanks to Bloomberg Intelligence Senior Aerospace and Defense Analyst George Ferguson. That's this week's edition of Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies and 130 industries. And remember, you can access Bloomberg Intelligence via BI Go on the terminal. I'm Paul Sweeney. Stay with us. Today's top stories and global business headlines are coming up right now.